let's talk through, because you have been very vocal for a long time that you think the Fed is doing too much, that they were slow to get started on this, but now they have taken things too far. Jay Powell made it pretty clear yesterday that he has no intention of letting up at this point, that they think inflation is still rampant, it is still going to be very hard to get rid of. And as a result, their plan is to go higher and stay there longer. You're not buying it? You don't think that they will be able to do that in the second half of next year? They're going to have to lower rates?
No, not at all. And, as Joe pointed out at the very beginning, in the year-ago meeting, only 2 people thought that the funds rate should be above 1% this month. It's interesting. Only 2 people thought that the funds rate next December should be below 5%. I think that they're going to be exactly wrong in the opposite direction. They were way too loose before. Funds rate had to rise a lot, and now they're way too tight. And Becky, I was really very disappointed in Powell in his reasoning and his justifications for this overly tight policy. First of all, he acknowledged that the housing data is lagged, that housing prices are actually going down, but we're not going to see it until the middle of next year. So we're going to wait until the middle of next year before we, decide whether we need to pause the rate hikes. But even though we know it right today, I think we've got to get out of this, year over year look at inflation. Remember, when we get year over year, we're getting 11 months of old data, outdated data, only 1 month of new data. Yeah, and in fact, that 1 month contains data that he admits, particularly in the housing sector, is extremely lagged.
Sure, but Jeremy, I'm sure you'd be the first to admit that we can't look at every number and think, inflation has been conquered. If you look at 1 month's number, 1 month does not a trend make. That's why you look at the longer year over year. And you're right. It came down year over year because you're rolling off some of the highest numbers. But, we looked at year over year on the way up when things were really hot, too.
But the Fed has to be forward-looking. Let's go to the wage part, because I think that's really interesting. They said, okay, so we have this housing, but wages is a problem. First of all, wages have gone up less than inflation. Steve mentioned that last month was one of the very few months where wages actually ticked a bit above inflation. But over this whole pandemic period, wages have fallen short of inflation. It's hard to understand that is an inflationary force. But more important, he brought it up something new. He said there may be a structural shift of a reduction in labor supply. Well, what does economics say? If there's something that is a reduction in supply, you've got to let its price rise. That's economics 101. You can't suppress structural shifts. The Fed is not supposed to act on structural shifts on supply side problems. Remember, Becky, a year and a half ago, Chairman Powell said, we're not going to act against inflation because there's supply side problems. Now he's saying, there's supply side problems in the labor market that may raise wages, and we have to crush the wages in order to stop inflation. They're totally inconsistent as a part of monetary policy.